Barbara O'Neill is our distinguished professor emeritus, and Barbara had an awesome career with Rutgers. She's a certified financial planner, and we're really happy to have her with us this evening. So, welcome, Barbara.
Okay, I'm very glad to be here. I'm coming to you from Ocala, Florida. And as I put in the chat, we are technically the horse capital of the United States, and we are the home to the World Equestrian Center. So if any of you are involved in the equine industry, if you're ever in Ocala, look me up. It's a great facility. Okay, so I'm going to share my slides now. Okay, so the topic of this presentation was one that Robin and I came up with, and it's called, Can Farmers Ever Afford to Retire? And I'm here to tell you that the answer is yes. That there are definitely many paths. I'm going to talk to you about 8 of them that you could use as sources of retirement income, and 5 of them are really things that anybody can use, whether they're working in farming or any other type of career. The others are kind of unique to agriculture, and hopefully give you some ideas for planning. And I'm going to start out by saying that the best way to make a plan for retirement and your life later on is to think about what you'll be doing. So I'm going to throw out a question to you all that you might want to just kind of be thinking about silently is, how do you picture your retirement? What will you do? And where will you live? We did a focus group some years ago when I was with RCE with some farmers in several different counties around the state. And we were doing that in preparation for writing the Later Life Farming online course, which I'll talk about in a minute. And what we found clearly from a lot of the farmers that we interviewed in New Jersey were that they preferred to think about themselves as aging in place. They had no plans to leave the farm. And in fact, they wanted to continue to work in some capacity, maybe not full time, but still being very active in agriculture. So you may feel that way, or you may be completely different. Maybe you want to leave New Jersey and come down here to the Sunshine State and start a new life somewhere else. So there's no right answer. Whatever you want to do, that's going to define in many ways how much money you're going to need and how you'll be spending your money depending on what's of importance to you. So just kind of keep that in mind, that everybody is going to have some different opinions on what they want to do. So I'm going to talk about common retirement income sources for farm families, but I just want to note that not everybody is going to have every source of income working for them. But I will say that the more sources of income that people can have for later life, and this is for anybody, farmers or anybody else, the better, because if you can have multiple streams of income, it's always a good thing. Just like in your farm business right now, it helps to have multiple streams of income and not just one source. So many people have crops, they have agritourism, they have lots of different things going. Same thing for retirement income. If you can have multiple sources, that's always a good thing. Okay, so the first one I'll start out with is Social Security, which pretty much, I think it's like 92% of all the people in this country get Social Security. Just a small subset of government workers in a handful of states do not get Social Security. So bottom line is you need to have 40 credits. They sometimes call it quarters of coverage, which basically translates to 10 years of work that's covered by Social Security. And of course, the earliest that you can claim Social Security benefits is age 62. And as you can see on the chart there on the slide, that if you wait, and you can wait up until age 70, it doesn't make any sense to wait past that because there's no additional increase in your benefit. You can see that your benefit will go up as you delay the receipt of your benefits. And your Social Security benefit is based on the 35 highest earning years that you have in your work history. So if you work beyond 35 years, some of the lowest years might drop off and be replaced with higher years. So they're going to take the 35 highest years. And like I said before, if you delay up to the age of 70, you will get credits between your full retirement age, which for many baby boomers is 66, and for anybody born in 1960 and later, it's age 67. Between that full retirement age and age 70, you'll get those extra credits that will boost your benefit. So that's a key decision that people will make. So sometime in your 60s, you will want to claim Social Security. Okay, some of you may have an off-farm job in the family, either yourself or your spouse, and that job may have benefits associated with retirement planning. So if for very fortunate people, and maybe people who got into farming as a second career might also be in this situation, very fortunate to have a pension, because very few people, relatively speaking, have pensions anymore. But if you do, that's great. You've got that as a source of income. Or if you or your spouse, again, in your non-off-farm job, have access to what they call a salary reduction plan, which would be 401ks in the corporate world, 403bs for teachers and people like us at Rutgers, and nonprofit hospitals, things like that. 457 if you work in state and local government, and the thrift savings plan if you work in federal government. So they call salary reduction plans. You can put some money aside for your retirement. And then if you have access to any other employer benefits, that's great too, like health insurance, which again is pretty rare. Another thing that farmers can consider is rental income, having some streams of income coming from rents. So you can rent land, for example. If you have land and you want to rent it to another farmer, that might be something you might consider. Buildings, so farmers rent barns, farmers rent silos, riding arenas. There's all sorts of possibilities there depending on the nature of your enterprise. People might rent equipment, so you might be renting tractors and combines and plows and seeders and irrigation equipment, again, depending on the situation. Some people will rent animals, and maybe you can think of other things that could be rented too. So again, anytime you have a rental situation, which of course you'd want to have a contract drawn up with an attorney that specifies the rights and responsibilities of both parties, you have a stream of income, and that can become really important in later life. Okay, another one that you can have, and actually anybody with earned income can have, is an individual retirement account. And the government considers earned income from a salary or net earnings from a business, such as a farm enterprise. And the maximum contributions, they just raised again this year pretty significantly because they're tied to inflation, and we had such high inflation last year. Anybody under age 50 can max out at $22,500, and an extra $7,500 for people age 50 plus, older workers, so that they can contribute up to $30,000. Now, those are pretty hefty amounts, and that's just the max. Many people ask me at classes, well, what's the minimum? Well, the minimum would basically be whatever the financial institution that you're putting your IRA with requires. So, for example, if you decided to put it into a mutual fund, the mutual fund would have an amount of money that you need to deposit to open up a IRA account with them. So that's going to vary from the different custodians. And there's two types of IRAs. There's the traditional, where you put in pre-tax dollars, money that hasn't been taxed, and then the Roth IRA, which is your after-tax dollars. So with the traditional, you get to write off the contribution up to certain income limits. With the Roth, there's no tax write-off because you're contributing after-tax dollars, but then you don't have to be taking out required minimum distributions when you're older either. Some people say, well, what should I do, traditional or Roth? The best thing probably is to do a little bit of both. Nobody says you have to pick one over the other, because nobody really knows what their tax bracket's going to be in later life. So if you want to kind of hedge the uncertainty, you might decide for whatever dollar amount you want to put in an IRA that you would put half in a traditional account, half in a Roth account. That's fine. And then you can select a variety of investments to put into your IRA, because your IRA isn't an investment per se, it's just a place to put investments. So then you have to choose where your money is going to go. Stocks, bonds, mutual funds, exchange traded funds. Some people will open up IRAs with banks and put them into certificates of deposit. So you can select a variety of investments. There was even a custodian last year that made a big splash in the news that they were going to start accepting cryptocurrency. But there's a lot of uncertainty with that. I don't think I would go there. But it's an option apparently with some custodians, but probably stick with something a little bit more mainstream. Okay, as a self-employed person, you also have eligibility for what they call a SEP plan, which is a simplified employee pension. So this is another type of retirement plan that's designed for self-employed people. So that includes people who are self-employed individuals like myself. I operate a full-time financial education business, so I'm self-employed. I have a SEP, and it could also be for a small business owner that has employees as well. And the good news about the SEPs is that you're not too late for 2022, because there's very few things that you can do after the calendar year ends to kind of impact your taxes from the previous year. But you have until the tax filing deadline, which this year is April 18th. So that's why I put on or around April 15th to set up your SEP plan and also to contribute to your IRA. So you still have about 3 months to be able to do that. And the maximum amount you can put into a SEP if you're an individual person is 20% of the net self-employment earnings if it's your business. But the downside with the SEP is that if you have eligible employees, you'll need to contribute for them too. So I remember from that focus group that we did, most of the farmers were telling us that they would much rather just contribute for themselves and not have to be worrying about contributing for employees, particularly because their incomes are very variable from year to year. So I certainly appreciate that. But another question people often ask is, can you have both? And the answer is absolutely. You can have a simplified employee pension and you can have a traditional or a Roth IRA, assuming you have the amount of money to be able to do both. And then there's just plain old investment income. So wherever you've been putting money to invest, you have interest, you have dividends, you have capital gains. There are some farm operations where you might even have sold the mineral rights to your land. That's another possible source of investment income for some people. And there may be some other types of investments I haven't mentioned that throw off different types of income. Royalties perhaps would be another one. But again, depending on where you are. And again, if you're very conservative, you're probably going to be at the base of the pyramid and primarily having your money in cash equivalents, possibly some certificates of deposit, treasury bills, things like that. Want to take a little bit more risk, you would be kind of in stocks and bonds and maybe some real estate investments, which of course your farm is already that. And then right at the top, most people never invest at the top because that's where you have the highest risk. Options, futures, collectibles, things like that. You really have to know what you're doing to invest at the top of the pyramid. Okay, another thing for farmers is continued income. So remember what I said before, our focus group said that a lot of farmers were telling us they didn't want to stop working. They wanted to continue to be involved in the operation of their farm in some way. So continued income sources from the farm at any age would be obviously payments for crops, payments for animals, agritourism income. If you transfer the farm to an adult child or another new farm owner, and then you negotiate to stay on with them in some capacity, then obviously at that point you would be drawing a salary as an employee of the new owner, whoever they are. And then another option might be to just do something totally different from farming. Something, maybe somebody has a hobby. They've always wanted to play in a rock and roll band and they're a good musician. They might want to decide to do some gigs at weddings and just do something completely different from farm work with the talents and skills that they have. But again, to draw a continued income that they get paid for. And then finally, number 8 on my list is just selling things. Obviously, if you sell farm assets, particularly large assets, you can generate a large pool of money that you can then invest in and draw down incomes, capital gains, and everything else that I mentioned. So some people choose to do this by putting their farm into farmland preservation and having funds from that. Other people might choose to sell the farm and again have the profit from the sale be a source of income for them. So again, not every solution is right for every person. Remember I said before, you're going to kind of pick and choose. Kind of think of this as a Jersey diner menu where I've given you the whole menu and then you can pick and choose the strategies that seem to work for you. But again, the more that you can have going for you, the more comfortable your retirement is probably likely to be because you'll have more sources of money. I want to mention at the very end, before I open up for questions, just the Later Life Farming online course. This was developed by a team of Rutgers Cooperative Extension faculty, I'm thinking about 7 or 8 years ago now. And like I said before, we started with the focus groups with, I think we had 3 different counties in New Jersey. I know Sussex County was one, Somerset I think was another, and I forget the third one, somewhere down the south. And we just sat down with farmers and asked them a series of questions. And it was the responses that we got from those farmers that really kind of led us to develop the course and decide what content was going to be included. And there's 10 different modules, and in each module links to different resources and different websites that you can explore even further. So it just went through an update. One of the things I do for RCE now is I update all the content that relates to personal finance each year. So it's just been updated for 2023. And it has a lot of good information. There's a section on estate planning and farmland preservation, and again, some of the retirement plans that I mentioned. So I would encourage you to check that out if you haven't ever seen that course. That might be something you'll want to do during that homework break that Madeline was talking about before, if you have a little bit of time to do that. So I think at this point, we have about 5 minutes or so for questions, maybe actually 9 minutes. I'm looking at the master schedule, something like that. So I'd just be curious to see if anybody has any questions, and I'm going to pop up the chat again so I can see them. So Melanie has a question. I'll just go backwards. I see Melanie's. I just popped it up here. Can you collect Social Security and continue to work? Absolutely. I mean, I'm a prime example of that. I have full-time business. I have income coming in from my clients, and I also get Social Security. The only thing I would mention, though, is that there is what they call the earnings limit. And you have to kind of watch your income if you're before your full retirement age, which I said, if you're born in 1960 or later, it would be 67. So this year they upped it quite a bit because of the high inflation last year, but the earnings limit for 2023 is $21,240. So if you earn more than that, you're going to take back $1 for every $2 that you earn over that amount. Now, you'll eventually catch it back up when you later on, but it is something to consider. You know,
Barbara, is that gross or net earnings?
That's gross. Yeah.
For farmers, that's for dairy farming, that would be an interesting cap.
Oh, okay. Well, yeah, okay. Let me take that back. I'm thinking of an employee. I guess, if it's a farmer, you would be looking at what you would put on your Schedule F.
Okay, good.
I use a Schedule C, but farmers, of course, would use the Schedule F. It would be the net income that you're earning from that business. So, you've got the gross that you're getting, and then you have all your farm expenses, and you net that out and come up with the income that is the net from the business. That would be that. Plus, if you have any other source of income too, that might be coming in. So yeah, so that's the only caveat about working in Social Security. Once you hit full retirement age, you could make $2 million a year and the government doesn't care. But it's just those years between 62 and either 66 or 67, depending on your age, that you have to be concerned about the earnings limit. Okay, so Ashley has a question about the eligible employees for SEP. I believe it's defined as 1,000 hours in a year. The government has certain eligibility requirements, and I believe it's something like that, 1,000 hours a year. So you'd have to, it's be somebody that's there for a significant amount of time, and then you have to be careful because you'll need to contribute for them as well. And that's why a lot of the farmers told us back in the day that they just would prefer to contribute for themselves and not have a plan that has a responsibility for contributing to others as well. Maria, can you comment on a SEP IRA? Okay, well, SEP IRA is you would just have a custodian, just like a regular IRA. So again, it could be a mutual fund company, it could be a bank, it could be a stock brokerage firm, whoever you want. And you would basically fill out the paperwork, and again, the limits that I mentioned before, and it's pretty much the same as a regular IRA in that you have to choose the investments that you put into it. So again, it's kind of an umbrella. You set up the SEP IRA, and then you figure out, okay, do I want to put this mutual fund, or do I want to put a CD, or do I want to put some stock? You choose the investments that goes into it. Are there any other questions? Those are the ones that I've seen. Maybe Madeline, you've seen any others?
No, I think you got them, Barbara.
Okay.
Would anyone like to join in with a question or? Okay, well, hey, we have some questions for you then. We put together a little poll for you to take related to the topic, and just your thoughts. You don't have to know exactly the answers, but we just want to get an idea of what we think things cost. So the first was the average price of a new home in 1990.
It's interesting you should say that, because I just taught a class this morning on inflation. We talked a lot about how prices have changed in the last, couple decades.
Yeah, it's something. So you can go ahead and join the poll.
So,
Okay.
hi, everyone. This is Melissa.
Can we share the results, Melissa?
Yes. I
Okay.
took these questions out of some of the handouts and resources that Barbara has in her talk and in her links. So I thought these were just a good brain teaser, especially with the current inflation we're having. And if you've thought about buying a farm in New Jersey or expanding or looking at purchasing a new home. So in 1990, what did we think the average price of a home was? Looks like 44% said around 123,000 and 38% said 119,000 and 19% said 238,000. I believe 123,000 is correct. I'd have to switch screens to look at my notes. In contrast to when this article was written in 2018, the cost of a new home was $385,000. What do we think the cost of a new home is now in New Jersey compared to the rest of the nation? That was the average price of a new home. And you can put that answer in the chat. Do you think it's more than 385,000? Is it more than 500,000? Is it less? The third question, New Jersey's ranked at what section of the most expensive place to live in the country? And we were laughing about this earlier because I think everybody knows it's in the top 10, and I'm coming from northern Pennsylvania. So it's quite the cost difference between New York and Pennsylvania compared to South Jersey. So it's definitely in the top 10. Barbara said it's probably in the top 5. Question 4, for every decade that someone delays saving, the investment required to reach a savings goal generally stays the same. Good, no one answered that question as yes. 25% says doubles, and 75% of you says triples. And I had a D option in there. During a pandemic, it more than triples.
Wow.
We've seen a lot of evidence of that, and that may have been the same scenario in 1912, 1918, when we've had past pandemics. And the last 2 questions are to get you thinking about the difference between retirement income rules and regulations and how you plan, and then your local municipality resources that may benefit you for retirement. How important financially is meeting the New Jersey farmland assessment eligibility rules and filing deadlines every year for farmers who want to retire on their farm? 13% said, I don't know. Another 13% said very important, and 75% said critical requirement. And that is the correct answer. If you're looking at offsetting your expenses and your rent and your other costs associated with your farm by capturing it in that program, it's critical that you remain eligible and meet that annual reporting deadline. And then the last question, for retirement planning, do you think rent received from a farmer can be used to meet the gross sales requirement for farmland assessment? In other words, if you own the farm and you want to put that in farmland assessment and you have income from rent, do you think that will meet the gross sales requirements to be eligible for farmland assessment? Some of you said, I don't know for sure, 25% on that answer, 6% said maybe, 50% said yes, I think so, 19% said no, it cannot be used. So I want to read you what it states. Rent received from a farmer is not considered the sale of an agriculture or horticulture commodity and cannot be used to meet the gross sales requirement for farmland assessment. So that's just an interesting little thought to keep in your mind when you're thinking about in the future when you want to retire and you want to take advantage of the farmland assessment program in New Jersey. We have to have gross farm commodity sales.